Welcome back. Stocks are down this morning ahead of a busy morning of earnings off of the lows. However, Dow Industrials right now down 98, S&P down 11, NASDAQ lower by 56. Investors are questioning whether or not Microsoft will bust up the tech party tonight when it reports its earnings after the bell. Expectations are not as high as top companies announce layoffs. We are expecting minimal revenue growth, 3%. Joining me right now is Portfolio Wealth Advisors President and Chief Investment Officer Lee Munson. Lee, great to see you. Thanks very much for being here. What's your take on the earnings season? And also, tech had a horrible 2022, but it's had a very strong early 2023 so far. Is that a signal we should be buying into growth again?
I don't think, here's what I think it's a signal. I think, I'm a value-oriented guy, and so I'm always tilted more to that, and that did very well last year. I think that tech is going to have its day in the sun for the next few months. You know why? Corporations have been cutting costs and raising prices. And our expectation, I don't know what Microsoft's really going to do. We're going to see, later today. But I think the expectation is that they are low and companies are going to do better than people expected, even with a lower expectation. And I think this sort of flies in the face of a horrible first half and then everything's going to get rosy at the end of the year. I would say enjoy what I'm calling this sort of fake rally in tech because it could last for many months. And I think it's going to rise all the ships and give people a lot of confidence. But the reality is that as we start, going forward in the year, I don't really see how we're going to have the softness that everybody wants to think that the Fed's going to start cutting rates near the end of the year, which is going to continue that tech rally because tech needs cheap money and rates going lower. And when you add in the fact that China's coming online, what do you think that's going to do to aluminum, copper, and oil prices? We could start getting a little bit more persistent inflation that's going to shock people. And also, just in general, when I can't even tell if I'm out of consensus or in consensus, I think you're in a trader's market. So I would enjoy the rally. I expect it to continue. But like I was doing back in November, I would rather sell into this rally. I think that we're going to have more persistent inflation. And if you love this tech rally, just remember, if things are too good, the Fed is not going to make it easy on your money-losing young tech stocks.
Yeah, look, that's what I was looking for. That's exactly what I thought was really the answer. Sell into the rally, Lee, because we're expecting an economy to slow down. So where's the value? Is it in oil stocks? Again, they had a phenomenal 2022, a phenomenal 2021. Even in the face of this climate change agenda, we're getting the first read of the fourth quarter GDP out this week. It happens on Thursday. We're getting the Fed's preferred read on inflation, the PCE index, out on Friday. We are expecting an economy that is slowing down. What does that mean for value right now? Do you want to buy things like oil stocks? And you just said, what do you think China's opening means for commodities? Are you saying you want to buy commodities?
I'm not a big commodity lover, but I'll tell you, if you own some commodity stuff, I wouldn't exactly sell it. I understand it's a big run-up. Everybody wants to buy at a low. Nobody wants to sort of, especially with value stocks or energy stocks, everybody wants a good deal. But I think energy will continue to perform. How much it outperforms, I don't know. But I wouldn't be selling a bunch of oil stocks right now. And I think that when you look at industrials, which a lot of tech lovers say, well, they're overpriced. They're not overpriced. They're just having a decent run right now. So I would say commodity related, whether that's energy, whether that's industrials, whether that's materials. I think that they have legs this year. And I would say that you're even going to be looking at things that do well when earnings start to decline, which is not tech, which is going to be things like healthcare and the utilities. So a lot of stuff that did well last year, I think will continue. Just because tech stocks went down a lot last year doesn't mean that the fundamentals are there. You have to have cheap money, you have to have disinflation, and quite frankly, everybody wants a dividend on Friday versus growth 10 years in the future that may not happen. Be pragmatic, trade accordingly, and I think in the next couple months you'll get some really good deals on cheaper areas of the market, and that's where you should put your money for the rest of the year.
All right. Dividend payers are good. Lee, it's good to see you. Thanks very much. Lee Munson joining us this morning. We will keep checking back with you.